In this video, we will examine the top 5 stocks purchased by our 77 great investors in the first quarter of 2023, as recorded by Dart Aroma. Welcome to Financial Fortune, the channel where we uncover the most promising investment opportunities and guide you towards financial success. In today's highly anticipated video, we present you with the top 5 stocks for the upcoming 2023 recession that smart money is actively buying. Join us as we unveil the carefully selected stocks that have the potential to weather the storm and generate substantial returns during challenging times. Get ready to make informed investment decisions. This is Financial Fortune. And we get things off with the 5th most purchased stock by our top investors in the first quarter. It was the Intuit company. In total, 7 A-list investors joined us throughout the quarter. The company divides its revenue into 4 main categories. Small businesses and freelancers use QuickBooks and MailChimp, while individuals and families use TurboTax. So, bookkeeping apps for startups and tax software for individuals. Together, these divisions account for close to 80% of the company's total revenue and nearly all of its segment operating income. Super investors obviously think there's potential here. The company's Credit Karma division will feel the effects of rising interest rates more than others. Their TurboTax sales will suffer as well if the jobless rate increases. Even though the preceding year's tax return determined the size of your stimulus check, the IRS is now reporting a diminishing number of submitted tax returns annually. The company faces several challenges that must be surmounted, but hey, maybe the price is simply too good to be true. Well, I should admit that I don't know this firm deeply, but on the surface, it definitely doesn't appear like the stock is down since the end of 2021 when they finalized the MailChimp purchase. It still sits about $415 per share, giving it a PE ratio of about 60. So, even if it seemed appetizing to 7 of our outstanding investors, I'm not quite convinced at first glance. So, if you have any background information on this matter, please share it with me in the comments. The 4th most popular stock purchased by our super investors in Q1 was also the most divisive. It was Meta. Meta has been under significant strain in recent years, not only due to their enormous expenditures on metaverse development, but also due to the decline in the profitability of their advertising. Since Apple has diminished the efficiency of ad targeting on their devices, many businesses have lowered their marketing spending in response to the current economic climate. Between its high in 2021 and its bottom in 2022, the stock dropped by roughly 70% due to the aforementioned issues. However, the craziest part is that stocks will rise again in 2023. Meta shares have increased by over 180% from their November 2022 low. So, our top-tier investors pulled off an incredible feat of timing. And at least recently, there has been some good news coming from the firm that shareholders may celebrate. Their most recent quarterly report shows a rise in sales over the previous year for the first time in 4 quarters. Sales are up 3% over the previous year. However, this must be weighed against the significant increase in expenses. Consequently, their operating margin has decreased from 31% to 25% over the last year, indicating that their entire operating income is still 15% lower than it was a year ago. However, there are limits to what can be improved upon in their efforts, and they did issue optimistic projection, predicting a range of revenue between $29.50 and $32 billion for the second quarter. What's intriguing, though, is that even if you take the lesser estimate, it still represents a 2% year-over-year increase in revenue. So, investors are shifting from deep pessimism, where revenue isn't going anywhere, to cautious optimism, where revenue may climb for 2 straight quarters year-over-year. Peter Lynch has said that you don't have to own a stock when it turns from excellent to outstanding. It's easy to discover turnarounds in which a stock goes from being really bad to being somewhat bad, and then the institutional investors come in and turn it around. This is certainly a pivotal moment for Meta, but historically speaking, it has only been highlighted by the most avid stock investors. This industry has strong long-term confidence from the smart money. In sum, we have Meta, and in 3rd place we have Microsoft. 9 of our top investors purchased Microsoft stock in the first quarter, and it's safe to assume that they've been riding the AI boom ever since. Microsoft shares are gained almost 40% following the debut of ChatGPT in November 2022. Although Microsoft does not operate OpenAI, the company behind Chat, the software giant is a major investor in the company. Earlier this year, Microsoft invested another $10 billion into OpenAI, expanding on a partnership that began in 2019 when Microsoft paid $1 billion to become OpenAI's exclusive technology partner. This development prompted OpenAI co-founder Elon Musk to essentially admit that OpenAI are now effectively controlled by Microsoft. Despite the fact that ChatGPT's success has had no discernible effect on Microsoft's bottom line, the market is already pricing the company's AI future into Microsoft stock. In an unexpected twist, these changes have also inspired Bill Gates to reinvest in the company, this time to hold for his foundation. It's grown to become his largest holding. Naturally, we need to provide greater attention to their main business, as Microsoft is built on a foundation of many software divisions. When it comes to Windows, Office 365, Azure, Xbox Game Pass, LinkedIn, OneDrive, Microsoft Teams, and the like, you can generally find some very robust switching options across all of these essential programs. Customers are obligated to continue paying Microsoft every quarter because of this software. And if AI is the cool new thing, I imagine that the robustness of their core business is what attracted the great investors. And with that, let's move on to the next most frequently purchased stock, Amazon. If I show you a snapshot of Amazon's stock chart, I think you'll see why 13 of our top investors acquired shares in the company. The company's stock has been reset to 2020 levels after it fell precipitously over the past 6 months, as a result of the adverse effects of the macroeconomic climate on their business. Amazon has invested heavily in capacity expansion over the past few years in order to boost sales and profits. But naturally, with the inflation we're seeing right now, their costs are growing at the same rate, and so are their costs of goods sold, operational expenditures, and eventually, Amazon's earnings. Although this pattern has been going on for decades, many value investors are wagering that the short-term sacrifices they are making now will pay off in the future. When discussing outstanding capital allocation, Amazon is often held up as a prime example. We now reach the most purchased security of the first quarter of 2023. This is known as Google Now. It's hardly surprising that Google consistently ranks first, second, or third on this quarterly list. Over the past year or two, Google has maintained relatively stable revenue despite advertisers cutting down on marketing spending, and its cloud business is still growing. The great investors, I believe, are of the opinion that the company can print money with ease because of its current momentum and the incredible financial buffer it has. They clearly have a very strong moat in internet search, which protects them more than a business like Meta because no gadget maker can really interfere with them. Unlike a device-reliant startup like Meta, Google is dependent on gadgets. Google is in a very strong competitive position due to the fact that almost everyone uses it and there is no close second. Even in a challenging macro climate, the moat provides adequate protection for cash flow. For instance, despite the ups and downs of the economy, their free cash flow has been rising steadily over the previous 4 quarters. In addition, the corporation has $108 billion in total liabilities compared to $115 billion in cash and short-term marketable securities. This, in addition to their moat, profitability, and the fact that the company traded at about $90 per share in the first quarter, is probably the mix of elements that attracted so many super investors to purchase the stock in the preceding quarters. And that concludes our insightful analysis of the top 5 stocks for the 2023 recession that smart money is eagerly investing in. We hope this video has provided you with valuable insights and actionable information to navigate the upcoming economic downturn. Remember to like, subscribe, and hit the notification bell to stay updated with our latest videos. At Financial Fortune, we remain committed to guiding you towards profitable investment opportunities. Thank you for joining us today. Until next time, may your investment choices lead you to financial fortune. This is Financial Fortune, signing off.